To halftime report, I'm Ekta Batra and with me is Sonia Shenoy. Well, we have to say that there has been a recovery in the markets after the down day that the US markets had overnight. We were bracing ourselves for probably what would be quite a roller coaster session, but nonetheless, there has been a bit of a recovery that we've seen for our markets. So our market's probably a little more optimistic at this point in time. But nonetheless, a lot of stocks in focus and especially on the downside. So you can't ignore stocks such as the IT space as well as Adani Group stocks. All of these are in the red at this point in time. Separately, just watch out for Devyani International. There is news on that particular counter and something like a Gland Pharma, which is managing to hold its head above the water. So a lot of news based stocks floating around in today's trading session.
Absolutely. And, you know, for the market as well, right? I mean, give and take everything, it's not such a bad outcome. We have actually, if you look at the Nifty intraday chart, we've actually recovered from the lows of trade. We're trading absolutely quiet right now, and the mid-caps actually moved into the green. So there is plenty of stock-specific action that we're looking at. If you're looking for stocks in the green, then there are a lot of auto stocks, M&M, Eicher Motors, a lot of real estate names, Oberoi Realty, consumption names like Varun Beverages, etc. that are all trading well in the green right now. So let's kickstart the show with some stock action. Infosys has slashed its variable payout for its employees for the first quarter to maintain its margins. Now, that's a money control exclusive. TCS and Wipro too have deferred or cut their variable payout. Money Control's Haripriya Suresh has all the details.
In what has become an industry trend, Infosys is now the latest company to make changes to its variable payouts for the first quarter of FY23. Infosys has told employees that they will, on average, the employees will receive 70% of their variable payout, but it depends depending on what their pay grade is and what department they're from. It has attributed this to margin pressures, primarily because of compensation revisions that it has done, as well as talent that it has hired. This, of course, comes soon after both Wipro and TCS have made similar announcements. TCS has deferred the payout for certain grades of employees, whereas Wipro has said that anyone in band C and above will not be receiving the variable payout for this quarter. This, of course, for Infosys, its Q1 operating margins was at 20% and its attrition was at 28.4%. All of them are seeing significant increases in wage costs as well as increased attrition. And what the impact of this move will be on Infosys attrition levels remains to be seen.
Okay, thanks very much for that interesting report there. But let's also understand what these variable payouts actually mean for the tech sector and where major players stand in terms of margin performance. Reema's here to tell us more.
Thanks so much for that. I just want to put in context the news that we're hearing from Wipro and now Infosys about variable pays being cut, and TCS as well. You know, there were reports about how they've deferred the variable pay by 1 month for a few employees. For one, variable pay is based on performance. So it's left at the discretion of the company based on the employee's performance. Also for an IT company, the variable pay is usually a part of the CTC and it's not a significant percentage. Also, that, another point that's being made is that if IT companies are bringing down the variable pay, will it hurt the attrition? Will we start seeing attrition levels go up? My sense is that unlikely, because IT companies have given heady payouts to employees over the last 2 years in this whole post-COVID digital boom. Now take a look at TCS. While TCS has not brought down the variable pay, we're just using this as an example. TCS's employee cost as a percentage of its sales has gone up by 300 basis points in a span of about 3 years. That just gives you a sense that companies in the last 2 years have handsomely rewarded their IT employees. And therefore this year, if they bring down their variable pay by a small percentage margin, it's perhaps unlikely that it's going to impact the employee morale. Also, we had Info Edge telling us that how even for this year, the core employees are going to be given a salary hike of 12% versus historical levels of 7 to 8%. So even this year, high wage costs have persisted, and therefore variable pay is a small percentage. It's a lever which IT companies have, and they perhaps are looking to flex it given the margin pressures. A word on the margin pressures, yes, they have come down significantly in Q1. Historical low margins for Infy and Wipro in the quarter gone by. For HCL Tech and TCS, margins were at 10 and 14-year lows, and across the board, we had cuts of about 100 to 200 basis points seen in the margin performance of IT companies. So the margin pressures are real, and perhaps IT companies are looking to flex the variable pay lever that they have in order to bring down the costs. But my sense is it's unlikely to hurt the employee morale too much. Back to you.
Okay, well, thanks a lot for that. In fact, a lot of brokerages as well, right, have gone ahead and downgraded the stocks. The latest one is JP Morgan. They've downgraded all the overweight call on IT players to neutral. Nimesh is here with more details on that. Nimesh.
That's correct. So, the global news flow, the domestic news flow and a JP Morgan downgrade has led to a big underperformance of all the IT stocks in today's trade. Now, the JP Morgan has turned further negative and underweight and bearish on the sector. And today in the morning, they've downgraded all the remaining 4 stocks which they were overweight on to neutral rating. The 4 stocks where they're downgraded are Infosys, Tech Mahindra, Emphasis and Persistent, all to neutral from overweight after the recent run-up in the price action. Now, they expect the margin erosion to persist in the medium term and stay meaningfully below the long-term trends. In fact, they see limited incremental margin levers going ahead for all the IT names. And in terms of valuations, the entire IT basket is still trading at least 40% higher than the pre-COVID levels, despite the fact that most of the peak growth is behind for all these companies and margins are structurally getting eroded. So on back of this, they've turned further negative and underweight on the sector. And today they've downgraded all the remaining 4 stocks to neutral from overweight, which is Infosys, Tech Mahindra, Emphasis and Persistent.
Okay, all right, Nimesh. Thanks very much for that. In fact, let's get a full 360-degree on the view on the IT space. We did catch up with Nilesh Shah of Envision Capital. Let's listen in to what he had to say on the sector.
There's already been a significant price erosion. A lot of the froth which has been there is clearly gone. You have 2 sets of components or players in the IT services space. One are really the big boys, the large guys, the top 3, 4, 5 names. I believe they are likely to be under more pressure because they never had a very, very strong demand environment. At best, probably their revenues grew at about maybe 10 to 12%. And therefore, the impact of margin pressures will be more felt by them. Versus that, some of the tier 2, the mid-cap ones, the specialized players, I believe the demand environment for them, in fact, will get even better. Yes, that's quite possible, Anuj. I mean, clearly, if global equity markets are going to be under pressure, if the US tech space is going to be under pressure, if indices like the NASDAQ are going to be under pressure, it's quite possible that we would probably see some softening or moderation in the valuations. Maybe it's not time to be in the generic IT services companies and be in the specialized mid-cap tier 2 IT services companies. That's where the opportunity is going to be from a multi-year horizon.
Okay, well, that's on the IT space, but let's move on now and talk about the pharma sector. Ekta is tracking stocks like Lupin as well as Gland Pharma. Ekta, why is that in focus today?
Well, on the back of brokerage reports, so Nomura has written on Lupin, they maintain a buy call with a target price which is lowered now to 863 versus 1098. They say that the stock factors in the current stress. High contribution from India growth markets provides downside support. Revenue growth and continued tight leash on overhead costs will be key drivers for margins going forward. They've lowered the target price multiple to reflect the headwinds in the US business. Separately, Goldman Sachs has written on Gland Pharma as well. They've initiated with a buy and a target price of 2,830. They say that it's a leading global generic injectable player with an addressable generic market size of $138 billion by FY27. In fact, they expect a rebound in FY24, modeling a 27% top-line growth, which is driven by factors such as a pickup in the rest of the world and India sales as supply constraints ease off while demand remains robust, and improvement in the US as well as core markets to double-digit growth on the back of new launches as well as share gains in existing products. Lastly, increasing production capacities, utilizations at key facilities is basically what is making Goldman Sachs quite bullish on Gland Pharma. But that's on the pharmaceutical space. Let's move on to a CNBC-TV18 exclusive. Sources tell us that Rare Enterprises backed company to file a DRHP with SEBI next month. Yash Jain is joining in with more details on this.
Well, that's correct. So it was just last week when another Rare Enterprises backed company, that was Concord Biotech, filed papers for its DRHP with SEBI. And now what we've been given to understand is that a new, of course, in the healthcare space, again, a new company again backed by Rare Enterprises is expected to file its IPO DRHP with SEBI, and that could happen as early as next month, that is in the month of September. This company, as I said, is IKS Health. What we've been given to understand is that this particular IPO is expected to only have an offer for sale element, and there is going to be no fresh issue as far as the IPO is concerned, which means the funds which the company would be raising would be taken by the shareholders. No funds are expected to come into the company. As far as the size of the IPO is concerned, we've been given to understand that the size would be around 2,500 crore rupees. The equity issuance for the 2,500 crore rupees would be about 15%, and the valuation that the company would get post IPO could be around 16 to 18,000 crore rupees. As far as the launch is concerned, September, as I said, is when they plan to file the DRHP with SEBI. Launch is expected to happen only next year, maybe by January or February of next year. So that is going to be an important timeline. As far as the board members of IKS Health is concerned, a lot of synergy between Rare Enterprises and the company's board. Utpal Seth, who's the MD and CEO of Rare Enterprises, is a director on the board of IKS Health. Also, Amit Goyla, the head of research and investment at Rare Enterprises, is also on the board of IKS Health. As far as IKS Health as a company itself is concerned, it's essentially an operator of healthcare solutions, primarily helps hospitals in managing their resources better.
Okay, thanks a lot for that. Well, let's slip into a quick break. The market is still very quiet, you'd have to say, absolutely flat. So it gives us some time to look at some chats that we had with exclusive chats that we had with some corporates. On the other side of the break, Umang Vohra, the Managing Director and Global CEO at Cipla, will be with us in our special series On the Record. Stay tuned. Miss, we have some excerpts from an exclusive conversation. Cipla is the stock on our radar. The company is hoping to double its India business from the current 10,000 crore rupees in the next 5 years. Speaking exclusively to Shireen Bhan, the MD and CEO of Cipla, Umang Vohra, said he is bullish on the consumer wellness space and the company will be able to grow to 1,500 crore rupees in the wellness space organically. Listen in.
We are very bullish about consumer wellness. I think this is a business that will require us to be a lot more D2C oriented as well, in addition to creating equity for these brands with doctors and with patients. So we have large number of brands in the pain space. We have a large franchise in the vitamin space. We are the leaders in the nicotine replacement therapy. And over a period of time, we will create more brands in the cough segment. We will create more brands in the mom and children segment. And I think we feel very bullish about this category in India.
Okay, and you continue to believe that you will be able to enter these new spaces that you spoke of within the wellness space, mom and children, for instance, organically or inorganically? What is going to drive the growth there from the 600 crores currently to about the 2,500, 3,000 crores that you aspire to over the next 5 years?
We think organically we can reach about 1,500 crores just out of the current portfolio that we have, or possibly even more than that. And the rest of it would come through new introductions in all these other segments that we spoke about. But also there would be an inorganic lift to this business too. We believe that out of the last 5 years or 7 years, we've demonstrated how to build bigger brands and how to experiment with these brands in different store formats, whether they are online or they are the offline grocer stores, offline chemist stores, as well as all the modern trade channels. So I think that's what's probably going to drive this. The doctor equity that Cipla has in the country allows us to brand our products and for them to be received appropriately by different audiences.
Let me then talk about the India story, because you said that you continue to believe that growth is going to come in from the non-metros, from the smaller towns as well. What is that going to mean, if you can quantify that for me? Today, the India opportunity for you is about 45% of sales, up 27% year on year. What's the 5-year roadmap as far as India is concerned?
Well, we think India can possibly double from where it is today. We have about a 10,000 crore business in India. We believe that that business has the potential to double in 5 years. And I think obviously it'll be augmented with an organic play, but also organic consumption, if I was to say that. But, you know, let's look at the demographic factors for India. We have so a couple of things have been enabled in in the Indian context. The first is just the birth of insurance through Ayushman Bharat and several other schemes, and this creates affordability for a lot of procedures that used to sit outside of several families. So I think from a government side, this has been a very big boost. The second is just the deepening of hospitals. If you were to travel in the interiors of India about 5 or 7 years back, and you were to do the same trip today, you'd suddenly see a lot of hospitals, lots of clinics, lots of chemist stores coming up in these cities. And I think that's, people don't need to travel necessarily to metros or tier 1 towns now to get treatment. They can hope to get it in the tier 2 towns and the tier 3 towns. So we see these as huge enablers of growth in this part of the country. So I think it's going to, for us, India is likely to be a market that doubles hopefully in 5 years, aided inorganically as well. And that's the opportunity for us. So we're 45% of the sale. We're hoping to keep the same percentage constant going forward as India begins to leap as much as some of the other markets that we are focused on.
What do you see as the big challenges and the big risks? You talked about the growth opportunities in India, but let me ask you the reverse question as the big risks and the challenges. Of course, price control and the changes in the regulatory environment, whether it is with fixed dose combinations or other issues. What do you see as the big risks with respect to the India business?
I think the big risk with the India business is largely going to be the organization of trade. And of course, at any point in time, policies by the government which create a shift in the marketplace. So we can talk about both. I think the organization of trade in terms of what share of the business will be occupied by the big chains is definitely a big risk. Today, we think it's about 10%. We'd like to believe this could become 20 or 25% of the overall business in the next 5 years, leaving a fairly substantial portion of the business still with the current mom and pop chemist stores. But that's one big risk because it has a pricing connotation to it and a margin connotation to it. I think the other big risk that I see is obviously any policy from the government which could create upheavals for the industry and or make it difficult for certain sections of operations. So I think those would be the two things that we'd be watchful for.
Right. Umang, let me then talk to you about what's happening as far as the US market is concerned. And there are a fair number of headwinds that companies in the pharmaceutical space are dealing with when it comes to the US market. But let's start by talking about the opportunities and what the pipeline looks like in terms of launches and what that could potentially mean in terms of the size of your US business. Currently about, 150 plus million. Where do you anticipate that going in light of the launches that you expect over the next few years?
Our US business is about 500 million, and we are hoping that that business also could benefit significantly out of launches that are coming. We think that the launches of products that we've been public about in the asthma and the COPD space are significant opportunities for us and for our size in the US. We also look at the peptide trajectory of products that we've been able to partner, develop on our own, which is also very significant. Each of these products could be very, very meaningful, almost to the extent of 10-15% and upwards of our current base. So as we see a range of products which are there, I think this business could significantly increase from the current levels to the levels that we think in 5 years. We think even this business has the potential of doubling in size in the next 5 years or so.
But how challenging is the pricing environment? Your peers that I was speaking to said that, look, pricing pressure is the reality that you have to live with. You cannot ignore it. And it's only expected to perhaps worsen given the administration's sort of very determined focus on ensuring that prices come down, which may not necessarily impact Indian pharma as much. But what's the pricing environment looking like at this point in time? And how much of a risk is that potentially going to be?
So the pricing environment in the US historically, if you were to rewind back about 15 years, has always been the 0 to 5, 0 to 10% type of price erosion that happens every year. The market deflates. And I think what happens is the only way to offset that is through new product launches. I think it works for us a little differently than the others, Shireen, and the reason for that is that our business is a relatively lesser size. So if the business becomes a larger size, your innovation engine has to work that much harder to be able to get the same benefit in your top line to avoid what you're deflating through pricing. So I think we don't have the same problem over the next 3 to 4 years.
Okay, and you can catch excerpts from this interview as part of our special series On the Record with Shireen Bhan all day today, only on CNBC. Back, well, for the mid-caps, it's managing to hold its head above the water, swap around 53 odd points. We still have the Sensex, which is down around 175 odd points. So let's see whether there is any kind of intraday recovery as we go on. Infosys is now your top loser on the Nifty, so that stock is down around 2.5 odd%. And neck to neck is Adani Ports, which is the second top loser on the Nifty, down around 2.5 odd% for that particular counter. But the stocks which are managing to hold their head above the water is definitely something like a Bajaj Finserv. That stock is up around 3 odd%. M&M, Grasim, Hindalco, Eicher Motors, all of these stocks doing quite well in today's trading session. Sachitanand Uttekar, our technical analyst for today, joins in on the show. Hi, welcome to the show. What are you tracking, Sachitanand, today in terms of stocks as well as the index?
Good afternoon, Ekta. Clearly, the kind of short selling that we saw in last 2 trading sessions, we've already seen a sharp cut in the indices as well. But right now, if you look at both the indices, I think they are comfortably trading near their intermediate supports. So if you look at the data of Nifty, especially if you look at the weekly scale, it has a very good strong support at around 17,340 kind of a zone, which is a confluence zone of its 5-week exponential moving average, and also the 20-day exponential moving average is trending somewhere close to that. So if you look at Bank Nifty as well, this particular level is very much similar when we see the 5-week exponential moving average for Bank Nifty, which is placed at around 38,050 kind of a zone. And even if you look at the options cluster, we are seeing signs that these supports should hold on for the next couple of trading sessions as well. So right now, I think it's a very good idea to look for a bounce back. I think this particular bounce back may mature in a day or so, and that's why we don't see any further selling, creeping in when it comes to indices. So probably Nifty should hold on to this support area of around 17,340. We may see a slight decline, but I think that decline should be bought in. The stop loss should be placed at 17,260 on a closing basis, and we are expecting a rebound back to 17,700.
Okay, expecting a rebound to 17,700. All right. What about individual stocks? What are you looking at?
Well, on the stocks front, we are focusing on relative strength displaying stocks, and the first name that came on my radar has been Bharti Airtel. For the last 3 trading sessions, despite of the market volatility, the stock was consolidating well. If you look at the overall structure on the monthly scale, we have a rising 3 kind of a formation, which is a continuation pattern. Again, on the daily scale, we saw a breakout from a flag formation, which is again a continuation pattern. So net, the trend looks very strong. We are expecting this particular trend to continue towards its life high. So we are expecting the levels around 780, 785 to be achieved in a couple of weeks' time. So it's a good idea to accumulate this particular stock in your trading portfolio. Keep a stop loss at 720. The second stock which has been locked into a very strong secular bull run has been Chola Finance. Even right now, we saw a breakout somewhere close to 660 zone. From that particular breakout, we saw a substantial rally in the last couple of weeks' time. The correction that we have seen so far has been bought in. We have a piercing line formation on the daily scale, which is again exhibiting this fact that there is a good amount of buying getting into this particular counter. So we are expecting this particular move to continue towards 826, 830 zone in the coming weeks. Stop loss should be placed at around 764, and even Chola Finance should be accumulated.
Okay, I just wanted to point out that there is a further sell-off that we're seeing in the IT stocks. So don't lose sight of that. Infosys, Tech Mahindra, TCS, HCL Tech, Wipro, the whole lot down about 1 to 3 odd%. Sachidanand, just a quick word on the IT names. If someone is a perhaps long-term investor in these large cap IT names, for a positional trade or for a slightly longer term view, would you be cautious or would you not be too worried about the fall that we've seen?
Well, when we look at the IT space, Nifty IT has already displayed a double bottom formation, and from that we have already seen one leg on the upside. Right now, I think it is a intermediate correction within the larger bull trend which we are witnessing. To unfold further. But if you look at some of these specific stocks, I'm not really comfortable when I look at a stock like HCL Tech. Already we have seen a substantial cut in the last two trading sessions, but this support at around 950 was something which was breached in today's session with a gap. So probably there are certain pockets wherein the downtrend may continue, but there are certain stocks which may be accumulated going forward. So I think one has to be very choosy when we look at IT stocks from a longer term perspective. I think HCL Tech could still underperform. But when we look at Infosys or TCS, probably we may see the undercurrent again getting on the bullish mode soon.
Okay, all right. We're going to leave it on that note. Thanks very much for joining in and giving us all of your picks. Thanks, Sachit Anand, for being with us this afternoon. Well, we're talking about losers within the IT space. Just want to point out a stock such as Anant Raj from the broader markets. That stock is shot up around 9% today on decent volumes as well. So that stock is doing quite well from the real estate space. And even something like Ashanti Gears is doing quite well. That stock is up around 12.5% as we speak. In fact, it's gained around 80% on a year-to-date basis. Take a break. And before we do that, it's a quick reminder for our viewers. It's that time of the year again. Money Control Pro's financial freedom offer is back with added benefits. Get a Money Control Pro subscription at net zero cost by claiming exciting offers worth 1,500 rupees from our partner brands. Grab the benefits now only on the Money Control app or website. Well, Eicher Motors is one of the top gainers today. The stock, in fact, has hit a fresh 52-week high. What's aiding the move? Sonia is here to tell us more. Sonia, it seems like it's really 2022 about the auto stocks.
Absolutely. And, Eicher Motors is not just rallying today, right? It's had a fabulous run. If you look at it, in 2022, the stock is up about 33%. It's up 12% in August already. It's hit a fresh 52-week high today. In fact, a lot of brokerages are extremely positive on Eicher Motors. CLSA has Eicher Motors as its top pick in the auto space. They've raised their target price to 4,154. And the main argument is that a lot of the Royal Enfield users will be replacing their bikes after a lifespan of 7 to 8 years. That fresh demand will come through, in the near term. And if Enfield can capture even 80 to 85% of that demand, then the volumes will grow significantly. CLSA also says that exports is likely to be a key growth area for them. And in any case, Eicher Motors Royal Enfield bikes EBITDA per vehicle has been going up. Currently, the EBITDA per vehicle stands at 42,000 rupees. It's expected to rise further to 46,500, led by softening commodity prices. So operationally as well, things are expected to look quite good for Eicher Motors, and hence the stock is rallying, has hit a fresh 52-week high today. But let's move on and give you some exclusive corporate opinion. Lata, my colleague, caught up with Hina Nagarajan, who's the MD and CEO of Diageo India. She spoke about the company's deal with InView and the consumption pattern amidst high inflation. Listen in.
The deal that we just announced a few months ago, we had said that we'll close it by end of September. So work is progressing on track and we hope to complete it by September.
Okay. Yeah. Well, now I want a consumer question. Yeah. What's doing well? Is it the mass brands? Is it the premium brands? Especially premium, prestige and above. How are they doing?
So, like we said in our new strategy that we will deliver double-digit top-line growth for our premium brands. We have so far delivered that mandate. The brands have been doing very well. I would say that we are beginning to see some slowdown, especially at the lower end, because of inflationary pressures and everything that we've talked about today. So definitely we see some slowdown in uptrading at the lower end. At the top end, we don't see slowdown, we don't see a reduction in consumption, but we are seeing a slowdown in repertoire drinking. So, people are cutting down on repertoire, but not really compromising on their brands, etc. So, looking forward, I would say I'm optimistic that with people returning to bars, restaurants, and us being able to celebrate face to face, we'll have a good season, and we'll continue. And we're committed to delivering our guidance.
No, I think that part of the economy is doing very well, the return to normalcy. But inflation is not going away. How is it affecting you? Is it continuing to be a problem? Because, if you look at the headline wholesale price index and consumer price index, it seems to have peaked off. But how is the experience at home?
We've not yet witnessed inflation reducing. We are still seeing pressure on our raw materials and packaging, etc. So I think this is going to continue for a few quarters. We are hoping it'll come down at some point in time, but I think the next couple of quarters we continue to see pressure.
Okay, let's slip into a quick break. On the other side, we'll get you an excerpt of our conversation with Cameron Brandt, the Director of Research at EPFR Global, to discuss the global market outlook. Stay tuned. Halftime report. Well, earlier in the day, we caught up with Cameron Brandt, who's the Director of Research at EPFR Global, and he says that investors seek diversified exposure via global emerging market funds like India, Korea, and he also gives his outlook on developing and emerging markets. Listen in.
The rally we saw, certainly from a fund flows perspective, was not heavily supported. It had some of the characteristics of a summer rally where a relatively modest amount of money can move asset prices more than perhaps more heavily traded periods of the year. And I'm certainly sort of seeing the turn downwards we've seen in the past couple of days as sort of part and parcel of that general pattern.
Okay, Cameron, hi, good morning. We've seen quite a bit of inflows into Indian markets over the last 1 month. Do you have any data to support whether this has been ETF driven inflows or more of a sort of long only money?
A little bit more long only. India's been attracting certainly over here, some very favorable investment bank commentary recently, and it certainly hasn't hurt that India's, the economy you're most frequently measured against, which is China, has sort of run into definitely a sticky patch. So we've seen a definite uptick in interest in India. With funds based outside of India and with more of a long-term perspective.
Okay, so you're saying that India has been attracting favorable investments from foreign investors. In the emerging market basket, how do you see the trends shape up from here? There's been an inflow of about $20 billion already into emerging markets, but do you expect that inflows could continue, and where does India feature on that list?
So I think they can. We're certainly seeing the start of a reassessment of the sell-off that emerging markets have seen for multiple good reasons. What we tend to see in those early stages is that investors seek either diversified exposure through the global emerging markets funds, or they head towards the big five. India, Korea, China, Brazil. Well, actually, it used to be Russia, but that is obviously not the case now. So I should say at the moment it's the big four. We've definitely been seeing that. Brazil, as well as India equity funds, taking in, I think it was sort of a 4-month high, last week's flows into dedicated India funds. There was a notable spike in flows into both China and Brazil equity funds as well.
Right, you're saying that inflows into India dedicated funds last week, the last set of data that you have, was at a 4-week high.
More than that, I think an 18-week high.
Sorry, okay.
So yeah, so there's probably been a noticeable increase in interest in the biggest emerging markets. And obviously India is a paid-up member of that group.
Right. No, so, you mentioned the big five, right? And you said, well, it used to be 5 at least till Russia was there. But should it, some are saying that even out of the 4, should it actually just be 3? It's just a hypothetical. Because of all the problems in China, are we seeing any of that dramatic sort of movement in flows, etc., with respect to China? And how will that behave? I mean, what will happen if there are outflows from China? Does it get reallocated to other emerging markets or goes into GEM funds? Yeah.
Right. No, a very good question. What we've been seeing so far is more focus on the collateral damage than China itself. There's still certainly from the institutional flows that we track an assumption that China has both the political will and the fiscal firepower to keep this current pullback at manageable levels. Where we've been seeing China's current issues show up is in flows to funds dedicated to markets like Japan, which relies on China now for a fifth of its exports, and a lot of the smaller Asian markets, which are also, now in a position. It used to be said that when the U.S. sneezed, the rest of the world caught a cold. Certainly now China's relation to its smaller neighbors sort of somewhat fits that particular way of looking at the world.
Cameron, are you starting to see outflows from the commodity-driven markets given the rise in the dollar?
Yeah, in fact, we have not really seen any strong movement this year towards either commodities or energies funds, which, given the inflationary environment and the pricing power that some of the sort of key names in those sectors have found themselves with, is a little bit surprising. But I think that by the time sort of sentiment adjusted to that new reality, investors have also or had already started to look forward to less dynamic economic growth, and also a response to pretty rapid government intervention in some of these sectors. In energy, we've seen efforts to cap prices, Mexico trying to, or moving towards renationalizing its energy sector. So I think, somewhat to my surprise, we've not seen strong flows into those fund groups for most of this year, but I now think that the forward picture suggests that that's, not an unreasonable position to take.
All right, that's the flow picture. Time for a break now. On the other side, Manisha Gupta, commodities editor, will be joining in.
And what we are keeping an eye on today is right now the tea prices, where we have seen more than 10% of a jump up in the prices in the month of July, because the June production definitely seems to be slowing down. Prabir Bhattacharjee, Secretary General at Tea Association of India, now joins us on the show to talk further about that. Mr. Bhattacharjee, hi, welcome. What's your sense? Because the month of July really seems firing up. The latest data from the Tea Association, rather the Tea Board of India, shows quite a strong run-up in the prices.
Yeah, thank you. Good afternoon to everybody concerned. You're very correct. The production in the month of July was muted, since the North Indian crop were affected by the floods in the tea growing regions of northeastern India, that is Assam and West Bengal. But yes, so far as the prices are concerned, Manisha, let me report that, yes, there has been a surge in the prices in the orthodox tea. You know that the orthodox tea does command quite a good price, and this year it has been better prices are being seen all around over there. And with the production base of 100 to 120 million kgs in the orthodox tea, the export figures seem to be optimistic for the tea industry. And there has been a surge of at least 75 to 100 rupees per kg in so far as the orthodox tea is concerned.
Okay. Also, Mr. Bhattacharjee, the rains have been quite erratic, and we have seen an impact across various other crops. How is tea dealing with it?
See, yes, July has been a very dismal month for the tea industry in North India. As you know very well, North India produces 80 to 82% of the country's production. So there has been a drop of at least 15 to 16% in the production of July 2022, against a crop of 158 to 160 million kgs. For the month of July 2022, the crop figures returns has been only 143 to 144 million kgs. So there has been a huge drop in the month of July. And Manisha, one shouldn't forget that the production accelerates from the month of June to October. These are the period in which the maximum crop is harvested.
Okay. What's the kind of demand that we're looking at and the exports as well, given the fact that India is one of the major tea producers here? What numbers are you working with on that?
Manisha, let me tell you one thing over there, that so far as the export figures are to be gauged. The export figures this year should be better than compared to the last year, in the sense that we are expecting an export of at least 225 million kgs for the financial year 22-23. So this is a welcome step, because you remember last time we fell back below 200 million kgs. So that's a good sign, good augury for the tea industry. The export should be up.
How are you also looking at the Indian demand itself? I mean, if you look at per annum growth, how do those numbers stack up?
Manisha, the domestic demand, is as I think I have told in these broadcasts and in the past also, the domestic demand is very muted. It will be 1.5 to 1.75%, for a domestic population base of 1.4. 140 billion people. So the domestic demand is not picking up very much as one would expect over there. So therefore, the only redemption lies for the tea industry into hike up on the export figures. Now let me tell you one thing over here. Recently there was a meeting that was convened by the Ministry of Commerce. The Honorable Minister of Commerce, Piyush Goyal, he presided over the meeting in just a couple of days back, in which, you see the export figures are the only bright spark that we're seeing over there. There's a target of $883 million for the year 22-23. And we are already, doing well in the sense that 9 to 10%, there has been an increase in the exports vis-a-vis the last year. So that is one redeeming feature, one bright spot for the tea industry.
All right. Mr. Bhattacharjee, there's always a debate on whether India is a coffee drinking or a tea drinking nation. I mean, I think it really depends on what state are you talking within here. But are you putting that debate to rest? How are the numbers stacked up right now?
Manisha, I'll always put, there are very, very hard. I mean, the clienteles are very, in the sense they're very hard-boiled. So if there's a tea drinker, traditionally coffee drinkers are in the south of the country concerned, and the tea in North India. And then the variety of teas that you get all throughout the country. You go to Northern India, you go to Punjab, or you go to Kashmir. The type of the tea that you drink and the type of the tea that you drink in the eastern part of the country
are all very different. I mean, I can tell you in the same house, people drink different kind of teas. But tell me, which cup is more expensive? Is it coffee or is it tea?
Well, I think the coffee would score it. Would score up. No doubt about that.
All right.
At least I don't have any doubt.
All right. I also want to talk about there are various categories of teas which have come into the market, from organic to green and white and black tea and etc. I mean, are all of these categories doing well as well? Because a lot of premium product commodities seem to be suddenly have picked up.
Yes, there is actually, this is a good development that has taken place over there. There's more of an emphasis given by the producers on specialty teas. Now, the specialty teas could be, the purple tea, it could be the white tea, it could be whatever it is, But yes, there has been more and more emphasis that is now given on producing specialty teas. And the government of Assam has been supporting also, because they have announced subsidy for producing such specialty teas. Now one must remember that the bulk of the tea that is produced in our country is black tea or the CTC tea, whatever you call it over there. Orthodox is merely 10% of the whole production. So the market, if one has to be imaginative, one has to get a more price out of the consumer, then one will have to innovate, and these specialty teas are one way out.
Okay.
Okay, all right, Manisha. Well, on that note, what is it for you, tea or coffee?
I think I'm going to go with masala tea.
Masala tea. Well, I know people who drink 1 cup of tea and then 1 cup of coffee and then 1 cup of tea. So, you can get that flavor as well. But thanks very much for joining in and taking us through that conversation. With that, it's also a wrap on Halftime Report. Business Lunch up next.